All right, welcome back, everybody. We are here with episode 9 of the AVID Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about market cycles. What are market cycles, and why should I be concerned with market cycles? So let's dive into it a little bit. Market cycles. I mean, I think we all have a general understanding of what market cycles are. Market's up, the market down, goes down. There's corrections. There's recession, depression. There's growth, prosperity, recession, depression. Our typical market cycles. So where we're at in the market right now is we're up. We're top of the market cycle. We're high. I mean, the market conditions are completely insane right now. I mean, it's crazy. And if you look at historically, the market cycles every 12 to 14 years. Historically, our last big correction was in 2008. So what does that tell you? Just historically, we're due for a correction. We all thought, that many of us thought that COVID, when that hit year and a half ago, whenever it came about, we all thought that, all these unknowns, all this crazy things were happening in the world. All these crazy things are still happening in the world. Now we're dealing with supply chain issues and, everything like that. It's just insane where we're at right now. But when it comes to market cycles, market conditions, the last correction was in 2008. And here we are, 2021. Historically, we're due. And we all thought COVID was going to be the correction, the next correction, the next downturn in the market, the next, everything was going to hit rock bottom and fall out. Little did we know that coming through COVID, through the shutdowns, that the market was going to skyrocket. It was going to go insane. And what we saw, when we went into, when we went into shutdown, when we went into lockdown, I mean, it was ridiculous. I mean, it was very, very strange times. I don't want to say it was ridiculous. It was very strange times. I mean, the entire world was shut down. Construction was shut down. Real estate sales were shut down. The entire world, businesses were shut down. You couldn't go anywhere. There was a period of time where you really couldn't do anything. You couldn't go out to a restaurant. You couldn't go out and eat. You couldn't, you couldn't go to the mall. You couldn't go shopping. You couldn't go out and, live your day-to-day lifestyle. I mean, it was just insane. And we all thought that when that hit that, nobody's ever been through that before. At least I haven't in my lifetime, and many of us haven't. But we all thought when that shutdown hit, it's like, there's all these unknowns. What's going to happen? What's going to be the result? And, as I said, little did we know that when we came out of those shutdowns and we came out of that, the entire world being closed down, that, the market was going to continue to rise and actually explode. I mean, it's just insane what we've seen over the last year, and we're still seeing, at least in the real estate market and the market in general. Sales are up. Days on market are super low. Supply and demand are are and have been, at all-time highs, with real estate sales, days on market. We're seeing, it slowed down a little bit, but we were seeing, property would go listed, a property would go active on the market. There'd be multiple offers, highest and best. Single family homes were selling for $20, $30, $50, $100,000, over list price. There were buyers that were doing many buyers that were doing, no inspections, that were making offers unseen offers on the property. They would make an offer, waive the inspections, if they had the ability, making cash offers. And it's like, that's something that I've never seen in the residential real estate market, especially, in Pittsburgh and in the general areas. So, coming through the COVID, coming out of the COVID shutdown, I mean, the market just went insane. Don't get me wrong. There were a lot of very, very happy people. Sellers were happy. Obviously, agents, brokers were happy to move move inventory, rapidly move inventory. There was an abundance of demand, and not enough supply to go along with it. I remember seeing it was at one point after the shutdown, following the shutdown, that one of the agent friends of mine made mention that at the time there were this was, I don't know, maybe 6 months ago, something like that. He had made mention that, there's currently, 4,000 homes active on the MLS right now. And that time, the previous year, there was double that. There was over 8,000, close to 9,000 homes active on the market. So we just saw some crazy, crazy things happen coming out of the COVID shutdown. The restrictions, and the real estate, residential real estate market just took off, here in Pittsburgh and around, many parts of the country. I mean, I remember seeing that, with people, people being required or having the ability to, work from home and work remote. There were big problems up in, New York City with, along with, the rest of the world and many parts of the country, but, big issues with all the density in New York City. So I remember seeing that, that a lot of people now having the ability to work from home, work from remote, they were selling their place in New York City and going down to Florida. Why? Because better climate, better conditions. Again, that's personal opinion, but better climates, better conditions, and not to mention the fact that if you're leaving Manhattan or you're leaving New York City and you have a 1,500 or 2,000 square foot condo that costs you however many, $5, $10, $20 million, you can still take that. You could take that same amount of money and buy, a beachfront property that's 10 or 20,000 square feet. So, a lot of people were making that transition to a different state, to a different climate, because they now have the ability to work from home. What I saw in Pittsburgh, in the Pittsburgh market, is following the shutdown and following the growth post COVID shutdown, is homes were selling like crazy. Residential homes were selling like crazy, and higher price point homes were selling like crazy. Now I follow, regardless of where I invest, regardless of where our focus is, I try to follow the real estate market in general, just so I have an understanding of where we're at, where things are at, and where the market is. Not because I'm always looking to buy $1 million homes. I'm not, or not because I'm always looking to invest in commercial real estate, because I'm not. But I follow those markets just because globally I like to know where things are at, to benefit myself and to benefit our investment partners. We need to know what the market conditions are. So Pittsburgh Business Times, it's a great publication. They send out, daily emails. They send out a print ad once a week, and I blow through there. Sometimes I read the articles in detail. Sometimes I just skim through it and see if there's any highlights that catch my attention. But every year, the Pittsburgh Business Times posts, weekly, they do the top 25 list, whatever the topic is, the top 25 financial advisors, the top 25, healthcare institutions, the top 25, minority owned businesses, or, whatever it is, they do the top 25 list. So every November, the Pittsburgh Business Times does an article, does a publication on the $1 million plus home sales in the region. And I don't think that's a top 25. They just do a count on the number of homes that have sold in our region over $1 million. And I remember this past November, we're going back almost a year ago because we're October now. So this past November, their publication came out, the $1 million plus home sales in our region. The count was like 142 homes that sold over $1 million. And I remember at that time, the previous November, the count on the homes was a fraction of that. It was something like 35 or 45 or something like that. Like, a much lower percentage, 25-30% of what it was the following year. This past November would have been 2020. So I start diving into that. I start looking into that. Like what's happening? What was the big catapult in these $1 million home sales? And I started asking around. I started talking to friends of mine. I started talking to real estate agent friends of mine that I know and I value and I trust their opinions. And there was a number of things that led to those sales. And in talking with a friend of mine, I'm like, what the heck's going on with this market with these $1 million home sales? Because historically, yes, we have a lot of 7-figure sales in the Pittsburgh region, but there aren't that many. We're just for the most part, we're our median price point is much lower than that. I mean, our median price point has been sub $200,000 for many years. So to get to those $1 million sales, $1 million plus sales, there just aren't that many. I mean, that's that our region just doesn't support it. So I started asking around, talking with a friend of mine. I said, what's going on here? Like, what's your take on this? And his response was, and it made total sense. It's like, well, people have, financing is available, obviously. And don't get me wrong, when there are a lot of people that pay cash for $1 million homes. If you look at the transfers, there's a lot of cash sales, but there also are a lot of, and I know I probably just, that was like a total shocker for many of you that are listening, that people pay cash for their homes, but it is actually very common. A lot of people, that are, high net worth, pay cash for their home that they live in. Why? Because it's a liability. It's not an asset. It doesn't create revenue. So when you start diving into those details, when we started having this conversation on those price points, I said, what's your take on this? And his thought process was, or his take was that, when you get in, we're in strange times. One, financing is available. So, financing is available, very attractive financing is available. A buyer's buying power goes up. So, financing is available at sub 2%, 3%, 4%. Their a particular buyer's buying power is a greater dollar amount versus, if financing is 5% or 7% or 8%, it's a ratio, it's a calculation. Financing was available, attractive terms, not just percentage rates, but there different loan programs that were available, that are still available, with jumbo loans, requiring less money down, less money out of pocket, increases, opens up, the buyer pool for those price points. And then other good points in related to that, in his opinion, were, we're in strange times, and we're still in strange times. But people were stuck at home for many months. I think there was a 60-day period, close to a 90-day period, where the entire world was shut down. There was nothing to do. Couple that with the scare factor, that when places started to open back up, people realized that it's like, a lot of people realize they just want to, do more things at home, where prior to the COVID shutdown, people would have their home, and then they'd have their gym membership. They'd go out to eat. They'd go to the playground. They'd take their kids here. They'd go there. They'd do all these different activities outside of their home. Well, now, following the shutdown and following all the craziness, people wanted more of those amenities at home. They wanted a home gym. They wanted, playground for their kids, or a pool for their kids. They wanted more space to do more stuff at home, coupled with the fact that many people were living, obviously living at home, but now working from home. So if you have, two income earners, or two adults that, both work full time, Now they're stuck working from home. Well, you need 2 home offices maybe. So that takes your need from a 3-bedroom home to a 5-bedroom home, or a 3 or 4 bedroom home with some dedicated workspace. And then kids are being homeschooled. Kids were stuck at school. Now you need somewhere for the kids to have their schoolwork done. And people are transitioning. Financing is available. The market's good. There's people had obviously time to look for a new home because everybody's sitting at home with nothing to do. So they're buying bigger homes with more amenities, with more space and more things to do at home. So that was the take. It's like, and it made total sense, and I can completely understand and see why people would go from spending 500 on a home or 300 on a home to 500, or 500 to 750, or 750 to $1 million to get all those amenities and all that space that they now need at home. So that was a great explanation, or a great thought process on why the $1 million plus price point really took off in Pittsburgh. But when it comes to get back on topic, market cycles, the market cycles historically every 12 to 14 years. And as an investor, as a real estate investor, I try to be very, very conscious of what's going on in the market, and understanding market cycles. And don't ask me when the market's gonna crap out, when the market's gonna drop, when we're gonna go into another downturn, because I don't know. Nobody knows. Many people have their opinions. Many people have have the insider scoop on something that they think is going to happen that's going to cause the market to correct. But don't ask me that, because I don't know. What we do in our business is, as I have mentioned many times, the bulk of what we do is we operate under a private equity model, where we work one-on-one with private and institutional investors to create and manage portfolios. And the bulk of our portfolios are single family homes. We buy regular houses in regular neighborhoods. And why is that? Because regular houses in regular neighborhoods are not subject to market cycles. The model that we work, the strategies that we work at AVID and AVID Management Group are not subject to market cycles. We don't invest based on speculation. We do some infill new construction and some land deals and things like that. And the investment partners that are involved in those deals understand the risk reward ratio with those deals. But the bulk of what we do is safety, security, regular houses, regular neighborhoods. Our model is designed for long-term plays. Again, we just buy a bunch of single-family homes. We put them in portfolio. We set them up for the long term. And regardless of market conditions, regardless of market cycles, there is always a need for regular houses in regular neighborhoods. If you look at what we call the B neighborhoods in and around Pittsburgh, median price points, $100,000 to $200,000 after repaired value on those properties, there's always a need. There's always a demand for those properties. And you're going to ask me, well, what about in a down market? What about in a down cycle? Well, in a down market, people still need a place to live. If you get into those higher price points, the $500,000, the $1 million price points, and we enter a market correction where, unfortunately, people are starting to lose their jobs, or the financing, you hit that correction period in your financing where you have the adjustable rates. Maybe one income earner in that home has lost their job because it was subject to a market condition. Now there's not the income to support that big mortgage payment. Well, typically in a down market, when there's a correction period, the top of the market is what corrects first. So that's why we do some stuff. We do some projects that are in the higher price points, but the bulk of our investments are regular houses, regular neighborhoods, because people always need a place to live. And when the top of the market starts to correct, the higher price points start to correct, people still need a place to live. They're going to come back to, maybe where they should have been all along, in a regular house, regular neighborhood. Our model, it's a long-term play. In a down market, we have the ability to buy a little bit better. When we're constantly growing our portfolio, we can buy homes a little bit better. We can increase some rents. There's more demand. It's a supply demand, so we can increase the monthlies. But there's always a need for those regular houses, regular neighborhoods. And when it comes to market cycles, if you're early on in your investing career, I've, over the last 3 to 5 years, I've seen many people that got into the business, that got started in real estate investing, that have grown their businesses tremendously over the last 3 to 5 years. And why is that? Because 5 years ago, we were at a certain point in the market, and 5 years later, the market has grown. So they've grown their business along with the market cycles. Now, depending on their investment strategy, if they're just doing spec builds, or just doing higher end flips, or just doing, just their focus is in that A market, and that's the bulk of their business, assuming that there's a lot of debt that goes along with those projects, that's total speculative investment. So if the bulk of your business is in that speculative side of the of real estate investing, it's been working in your favor over the last 3 to 5 years. But you have to understand market cycles, and the market is going to correct at some point. And if the bulk of your business is in those speculative type investments, you got to make sure, you got to be prepared to weather some storms. When the market corrects, we have no idea, how long it'll take to rebound. Historically, when a market corrects, there's 2 to 3 years as it goes down and as it continues to rise. And yes, with market cycles, the next high is always, historically, has always been higher than the previous high. So if you can weather that storm, in the long run, you will do okay. But unfortunately, most people that get started, as the market's rising, most people that get started in their investing, and focus on those speculative type investments, aren't able to weather the storm, because there's a time period, and typically, with those speculative type investments, they're done with high interest short-term loans. They're done, there's cost that goes along with those properties. I mean, if you're looking at rehabbing a $500,000 home in and around Pittsburgh, your property taxes alone are probably $10,000, $12,000, $15,000 a year. So trying to carry that along with utilities, over a 2 to 3 year period while the market corrects, I mean, that's that can be a big problem. And then multiply that by the 3, 5, 10 properties, 10 homes that you have under renovation at the time. I mean, that's just a disaster waiting to happen, in my opinion. So, when you're getting started in real estate investing, it's okay. It's okay to do the speculative type investments. Just make sure all your eggs aren't in one basket. Make sure you don't have your blinders on, where all you see is the market's good, the market's great, because the market won't always be great. When you're in real estate, or when you're in any form of investing, you want to have a diverse portfolio. You want to make sure that you have some investments that are safe, that are secure, and maybe you have an appetite to take some risk and do some speculative stuff. But make sure that all your eggs aren't in that one basket, because that's just a disaster waiting to happen. That's my take. That's my opinion on market cycles, market conditions, and what you can do in your investing career to to benefit yourself and benefit your family and your career, and of course your investment partners, in market cycles. But just, bottom line is please, if you've started your business if you're just starting your business, or if you've started your business in the last, 2, 3, 5 years, just understand that, we're in a great market right now, but the market will correct at some point. So that's my message for today. Have a great day, and thank you for tuning in.